Hello, everyone. Welcome back. My name is Mayur Thaker. I am an equity strategist here at Zacks Professional Services. I also co-manage the Zacks Earnings Certain family of portfolios. And this is another update on the macro picture. And today we're taking a little bit of a different topic. We're looking at a couple of different ways of valuing the market today. So today's topic is market valuation. Are we in a bubble or not? So let's take a look at that and check out what that might present to us. So I'm going to actually, for this presentation, I'm going to dive into our institutional research product that's called the Zacks Research System, as you can see here. This is an institutional level offering. It's a software suite of tools that presents fundamental and economic data using different tools and data visualization tools to be able to access and harness in order to make investment decisions. This is a platform that has 25 plus years of U.S. equity fundamental data, as well as 50 plus years of economic data, and a host of tools that lets you harness that data either in Excel or within the software to create your own investment strategies. So here I have in the main ticker box SP5M, that's our ticker for the S&P 500. This is essentially a bottom-up reconstruction of each of the 500 companies. And what that lets us do is we can then look at the weighted average fundamentals for the 500 companies that are in the index, weighted by their market caps, which is how the index is constructed. So I'm going to go over here to charts, valuation, and we'll just take a quick look at some of the basics, like, for example, forward PE multiples right now. And here we can see a chart of the S&P's PE multiple. This is looking at the existing 500 companies going back in time. And so today the market trades at just over 20 times forward earnings. And that's well off from the peak of 2020, as you can see there, and even further off from the peak of 2000. So remember, a lot of people look at the dot-com bubble of 1999, 2000, and look at that period as an example of a definite bubble, which was absolutely true. But if you use that as a benchmark, then we're quite a ways off from that level. In fact, we're even off of that level compared to where we were at the peak of 2020 and even 2021. So according to the forward PE multiple, we're not yet in a bubble. I mean, it's very difficult to define bubble. If it means that it has to be exactly the peak of 2000, then we're not in a bubble. But valuations are, as you can see here, very clearly well above the long run average. If you look at this entire history going back to 1995, the median PE of the S&P was about 16 times, almost 17 times, and we're currently above that at 20 times. Let's add a couple of trend lines on here to check out exactly where we are. Here I just added a +1, -1 standard deviation band in addition to the median value or the mean value over time. And as you can see here, we're actually starting to get to that point where we are 1 standard deviation above the long run, sort of the 30-year average. So valuations may not be as wild as they were in 2000, but they are by no means cheap right now. And so a lot is baked into the market currently. Whenever this trades at, 1 standard deviation above the average, it means that high expectations are being baked in. Now, it could very well mean that the S&P meets those expectations and therefore supports the S&P 500 at this level that we're at right now, above 5,000. But, that basically means that the higher the multiple is, the higher the benchmark is, or the higher the hurdle rate is in terms of the S&P's growth rate. So when we're at these types of PEs, what that really means is higher growth expectations are being priced in. That's the expectation. That's the baseline. And so the market has to meet or exceed that implied expectation in order to sustain and support the current levels that it's at. Let's look at a couple of other metrics like price to free cash flow. Here, this is even better than what we just saw. Price to free cash flow is significantly better or lower today than it was in the peak of 2000 and even throughout most of the 2000s right here. So price to free cash flow, I'd say, is even more important than PE. We all know the benefits of free cash flow. That's, one of the greatest, in fact, probably the most important metric for long-term investors is what is the cash generating ability of the company that you're looking at. And so for the S&P as an aggregate, you can see that the multiple is quite tame. The other thing that drives these multiples, by the way, is growth. And growth is partially tied to not just revenue growth, but margin growth. And here you can see, if we look at a couple of these different margins right here, for example, EBIT margins, the S&P 500 has relentlessly gotten better and better at extracting more for every dollar it generates in revenue. So we're off the peak of 2021. This margin compression is kind of the result of the disinflation that we saw, but now we're starting to see that pick up again. But again, that's bullish for the market. Again, at a 20%, EBIT margin, that's an operating margin of 20%. This is before interest and taxes, also before one-time sources of income as well as one-time expenses. So this is a true operating margin that we see here. And this is very steadily, although it's had a lot of cyclicality, it has very steadily improved over the duration of this entire chart. So you can see part of the reason why we have strong earnings growth over the long haul is because companies are simply getting more and more efficient at controlling costs. And that's what we see as a result of this margin expansion here. So again, from a basic point of view, which is forward PE multiples or even price to free cash flow multiples, we're definitely high on forward PE, but not quite at the levels that we saw in 2000. So if you look at these multiples here, this has happened before. As you can see, the market got to this PE multiple throughout 2021. And then it had a big compression, right, when we had that growth scare in late 2022. But when that growth scare never really materialized, when that recession never really materialized in 2023, we had this, very rock-solid recovery in the multiple of the S&P 500. So it is possible for us to still have positive returns going forward, even from a PE multiple base of 20 plus, as we saw here, right? So again, definitely extended, but possibly not overextended. However, what's the limitation to this type of analysis? PE multiples, right? Just going back to finance theory, PE multiples are a function of two and only two factors. Number one is what I already mentioned, growth expectations, right? If we have increasing growth expectations, then that justifies a higher PE multiple, all else held equal. But what's the other factor that we haven't talked about just yet? That factor is the cost of capital. So if you go back and look at the equation of DCF, right, when we perform a discounted cash flow valuation exercise, the cash flows are in the numerator, and then we discount those future cash flows back using a total discount rate, which is implied by things like the 10-year Treasury yield, as well as the equity risk premium. So let's take a look at that. And one of my favorite things to look at when answering that question, which is looking at valuation multiples relative to the cost of capital, is the Schiller PE. So I'm going to move over to the SPX. The SPX is the actual S&P index. So this is, we have to do this because we want to use the actual historical earnings of the S&P 500 to look at, say for example, the Shiller PE ratio, which uses historical earnings growth over time. And here you can see something a little similar to what we just saw with the PE multiple, and that is the Schiller PE is, again, definitely extended. We're at basically that +1 standard deviation band here, but not quite as bad as it was in 2000. And by the way, this is using the actual index constituent. So these historical values are based on the historical index values divided by the actual earnings of the index as reported over time. So this is a truly comparable measure going back in time, looking at 2000 to today. And in 2000, the peak was at roughly 39 times. That was the absolute peak. But for the most part, the topping out process happened at around 35 times, as you can see there. So, when the S&P went into a decade of losses, meaning, from the peak to trough, we didn't regain a new high for another 12 years. If you look at the S&P chart, let me just go back and show you that chart right there. From the peak of 2000, we basically double topped in 2007, and it wasn't until really 2012, 2013 where we set a new high. So that was basically a lost decade and a half almost, where we did not set a new high in the S&P 500, and it's primarily because we set such a high expectation implied in valuations at the time that it took that long for the S&P to grow into its valuation. So we're not quite there yet, but we're definitely high, as you can see from the Schiller PE. Now, the Schiller PE is fascinating. This is developed by Professor Robert Shiller over at Yale. It's a very fascinating approach to valuing the S&P 500. It's had a very strong track record at predicting forward 10-year returns of the S&P 500 because of the underlying methodology that this uses. The Achilles heel of PE is that it overly is reliant on a single year of earnings. So when you look at the PE multiple, either trailing or forward, that's based on earnings for either just the past year or the next year. So it doesn't factor in a smoothed out version of earnings, because any given year, the S&P 500 could be undergoing a change in the cycle, for example. So, for example, during recessions, earnings are depressed, right? And when earnings are depressed, the PE multiple could actually rise because earnings are falling very, very fast, right? So the denominator is decreasing at an increasing rate, and that often leads to higher PE multiples because stocks tend to move in advance of the actual earnings in decline. So when the earnings do decline, the stock market is usually, 1 or 2 steps ahead of that and has already bottomed out and is rebounding while earnings are declining. And so you actually see the PE multiple spike. So you would erroneously conclude that the S&P is expensive again, and that's not the case. So the Schiller PE corrects for that, so that it's never reliant on any one particular year. Instead, the Schiller PE looks at the 10-year moving average of real earnings. So that's inflation-adjusted earnings, under the idea that, inflation really should not explain value creation. It really should be that earnings are growing in excess of inflation. So it looks at the 10-year growth of real earnings and looks at the multiple to that moving average. And so again, the advantage here is that it really helps you understand when stocks truly get cheap and when they get expensive. So as you can see here, it was very, very cheap right around the bottom of 2009. But if you used traditional PE, you would have erroneously concluded that the market was not a buy at that time. So if you look at the S&P 500 going back to that to that ratio there, PE multiples started to expand very, very quickly, as you can see there. So the Schiller PE corrects for that by looking at a smoothed out version of the earnings. So you look at earnings over a complete market cycle over a 10-year period, as opposed to during any single given year. So what I'm trying to say here is that, we are like the traditional PE, we are one standard deviation above that, still well below the highs of 2000 or 1999. But again, nowhere close to the average Schiller PE over the past 30 years. Now, let's take this one step further, and that is looking at all of this relative to the cost of capital. And in this exercise, I'm going to use the 10-year Treasury yield as well as the 1-year Treasury yield as the examples of our cost of capital. So I'm going to dive into Excel world here, and let's look at the one adjustment to that. So what I'm doing here in this Excel sheet is I am taking the Schiller PE, right? And that's captured in this row right here. These are the Schiller PEs, also known as the CAPE ratio, the cyclically adjusted PE multiple. It's the same thing as the Schiller PE. So this is the historical Schiller PE of the S&P 500. It's basically the same data that we get from here, and I just put it into Excel form so I can look at the raw data. And then I take that number and put it as an inverse. So I want to look at the CAPE yield. So it's 1 divided by this value right here. So that gives you the yield. And that way I can look at it in comparison to the 10-year real yield. So this is the real yields that are published by the U.S. Treasury each and every day. That looks at the inflation adjusted 10-year yield. And that's basically derived from the 10-year TIPS bond. So remember, since the CAPE underlying calculation adjusts for inflation, we need to look at it relative to an inflation adjusted cost of capital at the same time. So that's why I look at the CAPE yield versus the 10-year real yield, and the difference between the two gives us the equity risk premium. So what my goal here is to look at the equity risk premium over time and to see where we stand today with regards to this equity risk premium versus where we have been over the years. And here is what that chart looks like. And here is where things start to get really interesting, because now you can see that when you bring in the cost of capital into the picture, the yield on the S&P 500 right now, the cyclically adjusted PE multiple yield, minus the 10-year real yield, is at 20+ year lows right now. We're at 22-year lows. The last time we got to this multiple right here, the last time we got to this spread, which is a roughly 1.5%, as you can see right here, 1.5% as of yesterday's close here. The last time we got that low was basically in 2001. So now this is starting to look like, valuations that are getting concerning. Remember, PE multiples, all types of multiples, should always be looked at relative to both growth expectations as well as the cost of capital. You have to look at both. We cannot look at PE multiples just in isolation because that's a nominal number. It does not factor in growth and it does not factor in the cost of capital. This exercise factors in the cost of capital. And this is telling us that we are currently trading at valuations that are higher, that have been the highest in 22 years, taking us back to 2001. So this is a very, very cautionary tale right now. Even if we're not plunging into recession just yet, which has been my sort of forecast for the last more than over a year now, I've been wrong on that. But that doesn't mean that we can't have very low, if not negative, returns for the foreseeable future from this point onwards because of how expensive stocks are relative to the 10-year Treasury yield. So this looks at the cost of capital. Now let's look at growth. So I'll move over to another chart that I made here. This is taking a look at a similar exercise, And let's see. Oh, here we go. This looks at a slightly different approach. So how I've done this exercise here is that I've taken the equity risk premium, which is derived from either the 1-year yield or the 10-year yield, and look at that relative to the forward PE multiple. So this uses Zacks estimates on forward-looking earnings per share for the S&P 500 and looks at the earnings yield based on that forward-looking estimate for each observation going back to 1994. So if I were to go all the way over here to the right, this number right here is the current S&P index level at 5,022 as of 4/17. And this 255.92 is the forward-looking earnings. So that incorporates both 2024 and 2025 weighted average earnings per share estimates. And this number is the yield for that. So it's looking at the forward-looking earnings expectation divided by the index value. That gives us the forward earnings yield of the S&P 500, and that's roughly 5%. And then we look at that relative to where treasuries are today. So I looked at both the 1-year yield and the 10-year yield and looked at the spread between the forward earnings yield and each of those two different treasury yields, just to take a look at what each of them are saying. And here is the result of that exercise. Just like the Schiller PE multiple relative to the 10-year real yield, this forward-looking multiple is also warning that we are trading at levels not seen since 2000, or 2001, I should say. If you look at the spread versus the 10-year yield, that's at 0.52%. So again, keep in mind, this factors in forward-looking growth expectations, which as of right now is 10%. So currently, analysts expect 10% earnings growth over the next year. And so even factoring in that bullish expectation, the earnings yield on the S&P 500 relative to the 10-year yield has only a spread of 0.5%. That represents the lowest spread versus the 10-year yield dating back to 2002. If I can find it exactly where that is. Yeah, it's been basically, hasn't been there since 2002. So, again, looking at forward growth relative to the 10-year yield, we are trading at the lowest spread to the 10-year yield in more than 22 years. It's even worse for the 1-year yield. You can see this number is actually negative. You can see that there. That means that the 1-year yield is actually above the forward earnings yield of the S&P 500. These are the lowest spreads that we have seen in more than 2 decades now. And the last time this got negative, besides, just about back in July of last year, the last time this got negative was basically when we were still exiting, or when that bubble burst in 2000, right there. So this is very important to keep in mind and keep in track of, because although we have not yet had the recession, right now, if you looked at the multiples that the S&P trades at, we're still well off the 2000 bubble peak. Even according to this exercise, by the way, I should mention that too. Both the CAPE yield as well as this equity risk premium, we're still nowhere close to where we were, at the peak of the dot-com mania. So there's nothing that says that we can't continue to drive this down, meaning that stocks can't continue to experience multiple expansion. There's no rule that says that we can't do that. But what this means is that expectations are very, very high. In fact, expectations are the highest in 22 years. And so probabilities suggest that forward-looking returns are not going to be good for the S&P 500. That's my takeaway from this. Now, if the S&P continues to deliver above expectations when it comes to earnings, then that's the Achilles heel of this process right here, where if the S&P comes in and beats expectations, if growth comes in strong, then these valuations can be supported. But as of right now, very, very high expectations for growth are being priced in. If we look at it relative to the cost of capital, which is basically either the 10-year yield or the 1-year yield, expectations are the highest that we have seen in basically 22 plus years. So this is not a good recipe in my view. I don't think that this is a very good risk reward for equity investors, especially in the S&P 500. So I personally believe that we should be looking for bargains out there or being defensively positioned in short-term treasuries because valuations are not very friendly right now. The bar is very, very high. So if we do not get 10% earnings growth, if it comes in at only about 5 or 6%, then that would not be a very well-received outcome in my view, because expectations are very, very high at this point in time. And again, this is only presentable, this is only apparent if you look at multiples in the right way, which is looking at them relative to the cost of capital as well as relative to growth expectations. So we would need something better than 10% growth this year, in my view, to support and sustain the S&P at north of 5,000. So that's my takeaway from all this. That was all I kind of had here. If you have any questions or any comments, I'd love to hear from you. Again, my name is Mayur Thaker. I'm an equity strategist here at Zacks Professional Services. And would love to hear from you. If you have any questions or comments, you can reach us at 1-866-794-6065 or send us an email to strategy call@zackspro.com. Thanks, everyone, and I hope to see you soon.